Good morning. Oh, sorry. Good afternoon, everybody now. I hope you're well, and thank you for joining us for today's Facebook Live. So I'm here today with Jonathan from Moore Smalley, and he's going to be talking about sort of like the true impact of Brexit on UK businesses and provide you with a little bit of advice from an expert. So let's get started. So we know that this year has been one of the craziest years with the coronavirus outbreak and all of the lockdowns and restrictions and lots of things that you as a business owner have had to deal with. But we are now fast approaching the Brexit deadline, which is the 1st of January. And we're going to be talking about what these changes are, how they're going to affect your business, and what you need to do to prepare if you haven't already. So, Jonathan, do you want to just introduce yourself a little bit?
Of course. Thank you, Rachel, and thank you for the opportunity to talk to your customers today. So I'm a partner at MHA Moore Smalley. Been working in VAT and indirect taxes for around 30 years now. And certainly share Rachel's comments and thoughts about this year. So the first half of my year was spent helping clients with all of the issues and the help that the government made available from a COVID perspective. In the last 3 months, my life has been taken over by Brexit. A lot of the clients that we deal with, I'm imagining, are similar sizes to the customers that you deal with. And for them, having Brexit on top of what we've already had to deal with this year was certainly not welcome. So a lot of the help I've been providing, which we'll run through today, is in here are the things to think about. Here are the things that will affect your business. These are the practical steps that you can take. So that's me.
Yeah. Wonderful, thank you. So if you do have any questions for Jonathan as we're sort of going, talking about Brexit in this live, please drop them in the comments and I'll try and get around to them at the end. But let's just get started with our first question, Jonathan. So can you sort of give us, just to start, a brief overview of what the changes are that are going to be taking place and how they are going to be affecting UK businesses?
Yes, sure. Testing my IT skills now. I'm hoping to share a screen that will have a presentation on it. Here we go. Fingers crossed. Let's make that into a slideshow. Am I okay, Rachel? Is that looking good?
Yes, I believe so.
Good. Let's move on then. So to start with some of the basics. So we left the EU at the end of January, but that was really in name only. We are, as I'm sure a lot of you have seen, the phrase transition period until the end of this month. I had wondered, with everything else that we've been dealing with this year, whether that transition period might have been extended, but it hasn't. And while we're in the transition period, we remain in a customs union and also in a single market. And what that means is all of the rules that bound us to the EU while we were actually members of it until the end of January still apply. From a trade perspective, that's good news because it means that you can move goods between the UK and the EU in a barrier-free way, I suppose you would say. No import entries, no export declarations, and no duty and no VAT. All of that, subject to a free trade deal, is going to change in, what are we now, 15 days. Deadlines for trade negotiations, as we know and as we've seen, have been extended on a number of occasions. We had the latest hard deadline on Sunday, and thankfully, although we're running out of time to do this, both sides are still talking, and therefore we will hopefully see a free trade deal emerge in the next few days. But one of the points to bear in mind as I go through this presentation in the next few minutes is that irrespective of whether there's a free trade deal, that won't affect whether you need to complete import and export paperwork. And I'll go through why that's different to a customs union and the single market that we're in at the moment. So if I move on, these are the well-publicized 3 areas that have been sticking points for a very long time now. And at various points in the last few days, I was just looking at the press, the media before starting this presentation. Fish now seems to be coming back as one of the reasons why there might not be a deal. But to my mind, the most important things and the thing that has got the most publicity is whether or not we will agree to be bound in a ratchet kind of sense to future standards that the EU might set in order for us to be able to continue to benefit from free trade on a duty-free basis with the EU. So that, I think, is the thing they're trying to work through at the moment. I understand the free trade deal is effectively already agreed, as long as these things can then be agreed to unlock what I think is about 600 pages of documentation. I've got 4 slides and then I'll pause, might come back to this presentation later on, to run through just in relation to the basics of how business will work from January next year. This first one is if you are an exporter from the UK and you're dealing with business rather than retail customers. Things to bear in mind, and again later in the presentation we've got more detail on this, is who is responsible for the exportation of goods from the UK. So what are your Incoterms, if you've heard of that phrase before? Basically the way in which the goods are shipped and who's responsible for paying the shipment costs and who's responsible for the importation of the goods into the customer's member state, which leads into who's paying import duties. Do you need a VAT or duty deferment account? If your customers are insisting, your business customers, that you sell to them in the same way that you sell today so that they don't complete the import paperwork when the goods land in the EU, then you may need a fiscal representative, which would lead to you needing a VAT number and an EORI. An EORI, an economic operator, I've forgotten what the R stands for. Basically, the number that you need in order for you to be registered with the customs authorities in the country in which the goods arrive so that you can actually arrange the importation, and whether or not you might need a legal entity in the EU. All of these are driven by the fact that, unlike today, when we're in a customs union from the 1st of January, there's a hard border between us and the EU. And all of the things that, for those of you that either buy or sell goods to non-EU countries, will already be used to, all of the import and export requirements that go alongside that. The flip side is if you're buying goods from suppliers in the EU, again, at the moment, that will be a simple enough process because there's no customs border, but there will be from January next year. And so all of the considerations about how you export goods, who's responsible for the import at the other end, who pays the freight transportation insurance, who bears the risk in those goods, applies in reverse. And who will be importing those goods if there isn't a free trade deal, who's building the potential duty into the price of those goods. Are you paying an increased price because they're now dutiable? In a similar fashion to if you're selling, are you going to increase your prices? Can you increase your prices to take account of the duty costs? I know one of the things that Rachel and I are going to get onto later on in the presentation, of course, is the associated costs of the administration that's involved in completing that paperwork. We then have, if you are a retailer, which I know from what Rachel has explained to me, a lot of you will be online retailers, some with bricks and mortar as well. If you're a retailer and you deal with customers in the EU today, the default position is that all of those supplies are subject to UK VAT to the extent, obviously, that the goods you sell are subject to UK VAT. And you may or may not have come across, depending on the level of sales you're making into the EU, something called a distance selling regime. So that if your level of sales to a particular member state goes above a certain annual threshold, the place of supply of those goods switches from the UK to the destination territory. And you would then pay VAT at the prevailing rate in that member state. Well, those rules, the distance selling rules, disappear from the 1st of January next year because, well, we're not in the EU and we're not in the transition period, therefore not in a customs union anymore. So all of your, and to add to that, all of your sales to customers outside the UK, whether business customers or retail customers, become zero rated because they're exports. And since we are a third country, not in a union with any other territories anymore, from the United Kingdom, of course, all exports from the UK become zero rated. In theory, and I say in theory, the second bullet point on that slide, from the 1st of July next year, a new regime is being introduced for all non-EU sellers of goods into the EU, which would require those non-EU sellers, whether in the UK, China, the US, or wherever, to register for EU VAT. It's something called the Import One-Stop Shop. And you would register in one member state of the EU and then report all of your sales to all EU customers, so potentially up to 27 member states of the EU, and use the VAT rate that's in place in that relevant member state. So there's an awful lot of accounting changes there. There's a need for you to understand what the VAT regime is in each of the countries you sell to, if what you sell could have more than one VAT rate, depending on the range of products that you're presenting on the website or through Amazon or eBay or any other online marketplace. And the rules also require, if you do sell through an online marketplace, but not Amazon selling as principal, but you using the marketplace platform, then those supplies, the VAT on those would be paid on your behalf by the marketplace. So there's some quite complex changes coming down the track next year. I say in theory 1 July only because I'm hearing that that may well move back to January 2022. In the meantime, as the rest of these bullet points allude to, your supplies to your customers in the EU would have no UK VAT on them, but depending on the value of them, when you sell them to customers in the EU, they may have to complete an import declaration. There are two particular limits which will be in place until these changes are introduced, one of 22 euros and one of 150 euros. If the goods you sell are below 22 euros, then they benefit from what's called low value consignment relief, which means when the customer takes delivery of them, they won't have to pay any duty or VAT. Between 22 and 150, there'd be no duty, but there would be VAT. So a key thing then becomes the buying experience, I suppose, because it's whether you would be comfortable with your customers having to pay VAT to get the goods delivered to them, whether to the local post office or whatever. Obviously, the buying experience would not be as straightforward as it is today. Turning to the other way around, and I can think of one of my clients, for example, who makes mobile phone cases and has warehouse both in Germany and a manufacturing site in the Philippines, although it's a UK business, this will apply to them. So if you are selling goods to UK customers and those goods, not where your business is based, but those goods are coming from a destination, coming from an origin, I should say, a place outside the UK, then the changes I was talking about on the last slide for outbound sales the UK is introducing very similar changes, but from the 1st of January next year, so imminently, which will mean that, I suppose, in brief, that those supplies will be subject to UK VAT in all cases, whereas at the moment, depending on the way in which they're shipped into the UK, they may be benefiting either from the low value consignment relief I mentioned of €22, which HMRC have translated to £15, or the higher level of €150, which in the UK is translated to £135. So there is quite a lot to take on board there. And also, as mentioned on there, the pricing on the website, obviously, if depending on who's responsible for the import, getting that price right is really important. So if there is duty or there is VAT, your website pricing might not reflect the actual cost of the goods to the customer. And also, it like the outbound provisions I mentioned for sales into the EU, if you sell via an online marketplace, then it's the online marketplace that accounts for the VAT, even if it's not in reality the seller of the goods. So that's a brief overview, Rachel, of the changes that are coming in. There's more to go through, obviously, but if we pause there and perhaps we could move on to your next question.
Yeah, thank you so much for that. Very, very detailed overview, I think, and I think a lot of people will appreciate that. So if you are a business owner and you've got to get ready for the 1st of January, what is the first thing that a business owner should do who does import and export goods? What is the first thing they should be doing?
I think the most important thing and the most common conversation I'm having with clients is to look at your supply chain, both directions, both purchasing and sales. Probably the most important thing of all at the moment is, can I carry on doing business in 2 weeks' time? And boiling that down to its most basic level possible, will I be able to move goods into the UK that I can then sell to my UK or overseas customers? So if you only have UK customers, for example, the first thing to consider is, where do my goods come from that I then sell? And I've had this conversation more than once, which is a client will say, well, I only buy from UK suppliers. Yes, but where does that supplier buy from? How secure is their supply chain? So that would be my first port of call. And if you buy from French or German suppliers directly, have you had the conversation with them about who's going to move the goods and who's going to complete the import declaration when the goods arrive in the UK? Because even if there is a trade deal, the paperwork still needs to be completed. So from a purchasing perspective, that would be the first thing, just the preservation of the supply chain, goods coming in. And similarly, from an export, do you know that you can sell goods to your customers in the EU in the same way that you are doing today? That will require reassurance that the freight forwarder you use knows what goods they're moving for you to a level of detail that might not have been required before now. Because if there is if there isn't a deal, rather, and there is duty payable, then when the goods land in the EU, then if it's DHL, for example, they will need to understand the goods that they're moving for you, because if you're expecting them to complete the import declaration to get the goods into the EU, because that's how you wish to sell to your customer, then they will need to know how to complete the import paperwork. So they'll need to know what the goods are, but they'll also need to know what their tariff classification is. So on the next slide, one of the things that I've mentioned here in point 1 is the UK Global Tariff. So this drives the level of duty you pay on goods coming into the UK. If you've looked at that, if you've heard of it, it's only half the picture. It doesn't deal with the rates of duty on goods that you send to the EU, because they'll be dealt with under the Common European Tariff. So if you are importing goods today from the US or from China, for example, the rate of duty that you would pay will be driven by the European tariff. From January next year, it will be driven by the UK tariff. But for exports you make into the EU, it will continue to be European tariff that applies. Some, I would say most actually, of the tariff classification headings between those two tariffs are identical. But as I found out yesterday for a client, not all of them. The rates mostly will not be the same. If there's a positive rate of duty, if there are 0 rates of duty, as there are for lots of goods, that will remain the same. But for positive rates of duty, the UK tariff is typically lower. And as this slide says, in some cases, nuisance tariffs, as they're called, under 2% have been scrapped. So you'll need to, there's a lot of housekeeping to be done. And I suppose the final point, if you're selling into the EU, might be, if I've got concerns about the ability to deliver goods, if I've got concerns about how to fill the paperwork in, and that country's not a particularly important one for me, might it be better to switch those countries off? If, I mean, I'm probably tell very quickly, I'm not an expert in how that might be done, but I understand you could just decline deliveries to particular territories while those steps are taken to better understand how those goods are going to move. So I think, Rachel, that would be my answer about first things first.
Yeah, wonderful. Thank you so much. I kind of just want to circle back round to the VAT implications. So could you maybe go into a little bit more detail about what those VAT implications are for businesses?
Sure. So to pick retail sales into the EU as the example, because I think from what you said, Rachel, that's probably the most likely scenario. If you're selling goods today to customers in France and charging them UK VAT, that is built into the retail price you sell on your website, then your pricing is quite straightforward in as much as UK VAT's charged, whether it be a customer in the UK or in Paris. And subject to the distance selling rules I mentioned, that would be the position that you would apply. From next year, your sale to a customer in the UK continues to be liable to VAT at 20%, if that's the relevant VAT rate for what you're selling. But to a customer in France, there's no VAT. And so immediately your pricing on the website is not the same. Or, well, it can be the same, but if it is, your profit won't be the same. Because if you sell to a customer in France on a basis, and I will cover the Incoterms shortly, but on a basis that means that your customer deals with the import requirements, then at the very least, even if there is a trade deal, those goods will be liable to VAT when they're imported if they're above 22 euros, as I mentioned earlier. At least until July, perhaps January 2022, when that new regime I mentioned, the import one-stop shop, comes in. So if you leave your customer to be the importer, customer pays the VAT, that doesn't feel like a good place to end up from a retail experience perspective. And you might wonder whether the customers would still be willing to do business with you on that basis. If you decide, well, no, I need to preserve the customer experience, that's obviously paramount. And so they are having as easy a journey through the buying experience that they do today, then your alternative is you import the goods into France. And you deal with the import declaration and you pay the VAT at the prevailing rate in France, which is not quite the same as the UK rate, but close. And there are other various rates below their standard rate, depending on the nature of the goods, that won't be identical to the UK. But the key implication of you being the importer, taking the goods into France and then selling them domestically to your French customer is that you're going to need to register for French VAT to deal with that transaction. One of the points to note is if you're selling to multiple member states in the EU, say France, Italy, Germany, Spain, to pick 4 examples, then you can, if you choose to, rather than register in every single country in which your customer is based, just register in one, then charge the relevant rate of VAT by reference to that country to each of your customers in the other member states of the EU, in the same way that you're doing today from the UK, but at a rate relevant to the country you've chosen. And again, conversation I'm having with other clients, logically, I guess the country you would choose if you're shipping by road would probably be either Netherlands or France, depending on the profile of your customers and where they are based, whether they're more in Northern Europe or Southern Europe, and whether you tend to go through the tunnel from Folkestone, or whether you tend to go to the Netherlands. So that would be a choice too. A lot to think about.
Wonderful. Thank you for that answer. So obviously a lot of this stuff is going to impact businesses quite a lot. And these changes, in your opinion, based on what we know today, because obviously there's still some stuff to come out, do you think once we kind of get a handle on things, the implications are going to be short-term, or do you think there's going to be a long-term impact for UK businesses that may be negative or positive?
There is nothing positive about Brexit from a trade perspective, and that's not a political statement about whether I'm a Remainer or a Leaver. It's just that all that Brexit does is put up barriers where they weren't before. And I haven't mentioned Northern Ireland yet. This slide does introduce the point, but there are all kinds of added complications in relation to Northern Ireland. We should, if we have time, try and cover off. There will be long-term changes for businesses, for example, that manufacture cars gets a lot of attention. The way in which the process works for cars to be manufactured, assembled, has multiple points at which it crosses borders between us and the EU, which has never mattered. So these, Rachel, are very much long-term consequences that will fundamentally affect the way in which UK does business with its largest trading partner. So that would be how I see it.
Wonderful, thank you. So this is a question that is probably on most business owners' minds, and I know we may not be able to give an exact figure, but roughly, do you know how much shipping products to EU customers from UK businesses is going to end up costing these UK business owners?
The shipping itself shouldn't change. If you're already shipping products to the EU, the actual movement of goods from point A to point B, in theory, ought to be the same. What will change and increase is what's called the customs brokerage, which is the process of dealing with the compliance of moving goods from point A to point B that involves crossing a customs border. And to break that down, if you're a vendor of goods into France on a retail basis, the goods need to have an export declaration, what's called a commercial invoice, when they leave the UK, and they need to have import paperwork when they get to their destination, an import entry that has to contain the right information to allow the customs authorities to understand what it is you're bringing into the EU, its value, its customs classification, that therefore drives the rate of duty if there is one, and the applicability of VAT, if that applies to, and at what rate, to the goods that have been brought in. That process, I mean, I'm hearing all kinds of different offers from different businesses. There are people like Channel Ports and Europa Flow based in the Northwest, and they approach this conversation differently. Some will charge a percentage, of the value of the goods. Some charge a fixed amount. It's hard to pick a figure. I've heard £35 to £40 per consignment regularly mentioned, but that's a bit of a stab in the dark, Rachel, to be honest. There is an additional cost. Back to sort of getting the basics right, there's a two-step conversation, really, which is, first of all, to understand, can your freight forwarder deal with the export and the import of these goods? Not all can. And if they can, what are they likely to charge? And what can I find out from the market to compare to those prices I'm getting? You don't have to get your freight forwarder to do your customs brokerage. You can get a customs broker to do your customs brokerage. I know of one in Manchester that one of my clients uses and speaks highly of. But the most common way of doing it, at least in the short term, and the simplest way of doing it, would be to get both in one place. So I hope that helps.
Yeah, wonderful. Yeah, that some good solid advice there. I think a lot of business owners will be very pleased to hear. But is there sort of anything that these business owners can do to kind of lessen the cost implications of shipping and importing to and from the EU?
Yes, definitely. I'm not sure. Bear with me while I flick a little through my slides. Yeah, I might focus on the Incoterms slide at this point because it'll be helpful, I think, to introduce this into the discussion. So if you are selling goods into the EU to multiple destinations, and sticking with those 4 countries of France, Italy, Germany, and Spain I mentioned earlier, if you shipped directly to each of those countries, let's say you used air freight, and that was the way in which you delivered in all cases, then on the face of it, you're going to need to register in each of those territories to deal with the import and onward sale of those goods if you intend to sell them DDP, which is, I'm hoping you can see, because like the pictures were in front of this part of the slide, but to the far right of this slide is something called deliver duty paid. And if you look at the table below and compare it to the far left, which is highlighted of X works, so, sorry, so deliver duty paid on that side. Sorry, X works on this side. You'll see a marked difference between who is responsible for moving those goods. X works, your customer's responsible if you're selling. For pretty much everything DDP, you're responsible for everything. So if you have decided, as discussed earlier, that in order for you to sell to your customers effectively and for the buying experience to be as pain-free as possible, you're going to import the goods. That means you're selling DDP. You would then need to register for VAT in that country in which those goods are sold. Now, in which those goods are sold being the relevant phrase there, rather than registering for VAT in all 4 of those countries, you could register for VAT just in France, which would mean that you would then sell from France to each of those other countries. That would at least minimize the administration involved, the cost of managing multiple VAT registrations. And if you remember what I said earlier about the import one-stop shop, then France may well be the territory you end up completing those obligations in the longer term. And so at least you've minimized the hassle factor and the admin involved in managing the process of selling to customers in the EU. And I guess turning that around, this may not be possible, but if you're buying goods, to the extent that this is possible, then get your suppliers to sell to you on DDP terms, because then you don't have to deal with the importation, and that reduces your costs. To overlay this, though, with if you're selling via an online marketplace, I had one client a few days ago, and Amazon are insisting that products are located in each of the, actually, I think it was those 4 countries I mentioned, in Amazon warehouses, fulfillment centers in each of those countries, and that my client dealt with all of the import requirements that went alongside that Amazon basically wouldn't, and I guess you can understand, given the number of people they deal with, why they wouldn't wish to deal with the import requirements for the movement of those goods. It certainly makes sense for you to pick one of those 4 countries to be the country from which you then move goods to each of those warehouses. Again, just minimizing the import requirements, minimizing the paperwork, and minimizing the compliance. So hopefully, Rachel, that helps to bring that point to life.
Yeah, that's wonderful. Thank you. Again, if you do have any more questions for Jonathan, please put them in the comments and we'll try and get to them at the end. I just kind of want to circle back to, you had some slides in there about Northern Ireland, and I'm sure
Yes.
a few of our viewers would probably be interested in what the implications are with shipping to and from there as well.
Oh, it's a nightmare, frankly. Despite what you may have heard and despite what may have been said going back a year or more now, Northern Ireland is in the UK and also in the EU for the foreseeable future. And everything then drives from that point. So if you are a business based in Great Britain now, so we're carving up the UK. So if you're a business based in Great Britain and you're selling goods to Northern Ireland, to customers based there, that in effect, in all but name, is an export. You still charge VAT at 20%. You don't need to end up with a VAT registration separately in Ireland, as you might do in the EU, as we talked about. But you would, in all likelihood, you may already have registered, you may have already noticed this. If not, then I'd highly recommend you at least look into it. Something called a Trader Support Scheme or Support Service, anyway, TSS. It's a database that HMRC recently launched, and it allows you to input all of the details required to log that movement of goods from Great Britain to Northern Ireland. One of the key reasons why that's required is because if you send goods to Northern Ireland, part of which are intended for customers in the Republic, then that's crossed an EU border, obviously from the UK to the EU, at the point at which it moves from Northern Ireland to the Republic. And duty may have to be paid on that. But irrespective of whether there's any taxes to pay, there are certain criteria, obviously, that the EU will continue to apply to the standards, the quality, the labelling, etc., of the goods that a non-EU country is selling into the EU that would need to be adhered to when those goods enter free circulation in the EU. One other point to mention, just more generally, in relation to Ireland, is that it's the one part of the EU that's in the wrong place. From the perspective of France, Italy, Germany, and Spain, if we're moving goods to those countries, to those customers, they're going in at least the same direction. Having a French VAT registration, yes, and importing goods into there is really not going to be any use at all if you've also got customers in Ireland. And more than one of my clients is having to register both in Ireland and in mainland Europe, depending on where you wish to pick, to deal with this issue. But to keep the focus on Northern Ireland, so if you sell to Northern Ireland, normal UK VAT applies. If you issue an invoice, normal VAT rates, all of those things continue to apply. In addition to you needing potentially a GB EORI number for imports into the UK from the EU, if you send goods to Northern Ireland, you're also going to need a Northern Irish EORI number, which will be something that starts XI rather than GB. So lots to think about. I've got a couple more slides, Rachel, just to cover this off. One of the ways in which, for me, this is illustrated most clearly is if, let's say you are based in Northern Ireland, or at least you have a base in Northern Ireland, and you manufacture goods there, or maybe you ship goods there from the Republic of Ireland. If you sell goods from Northern Ireland to customers in the EU, there's no paperwork, there's no tariffs, there's no quotas, there's no checks, there's no rules of origin, any barriers at all, because Northern Ireland is in the EU. And this is the consequence of the Northern Ireland Protocol, Good Friday Agreement, and not having a border on the island itself. The border is most definitely down the Irish Sea. So probably I think that hopefully helps to sort of bring to life at least the issues that we're going to have with Northern Ireland. There's one other point there, Rachel, which you mustn't lose sight of before the end of the presentation, which is rules of origin, on the way in which goods would benefit or otherwise from a free trade deal. But that covers Northern Ireland at least.
Yeah, wonderful, thank you. And just as we're coming towards the end, and we'll answer some questions in a minute, okay, is there anything else that you feel that UK business owners absolutely need to know about and need to take action on now before the end of the year that you want to cover?
Definitely. I'll pick up rules of origin at this point then. So customs union versus free trade deal. Customs union, anything that goes on within a customs union, there's no duty, there's no VAT, because the goods are in free circulation within that single territory. Free trade agreements are bilateral and rely on rules of origin. So what does this mean? I can most quickly bring it to life, I think, with clothing. In order for clothing sold from country 1 to country 2, wherever they may be, to benefit from the free trade deal that may be in place between those two countries, the goods have to have their origin in country 1. For clothing, there are commonly, not always, but most commonly, 3 ways of establishing origin. So if it's clothing, if it's woolen clothing, so the wool that comes off the sheep's back that's made into yarn, the yarn made into fabric, the fabric made into clothes. They are the 3 steps. In order for the goods to be to originate in this case in the UK, 2 of those 3 would have to happen here. And again, no expert, but my understanding from talking to a wide range of clients in the fast fashion sector, for example, is that it's highly unlikely that those goods would pass that test either in the EU or in the UK. And I have one client that deals in designer wear, so Hugo Boss is one of their suppliers. Boss has its warehouse in Germany, but those clothes are manufactured in, let's pick a country, Mauritius. And there is a free trade deal between Mauritius and the EU. There is also a free trade deal between Mauritius and the UK. But there isn't a free trade deal that can work if the goods go Mauritius, Germany, UK, because you only get the benefit of the rules of origin once. So the import into Germany would be free of duty under the free trade deal that Germany, or the EU rather, has with Mauritius. But when they move from Germany to the UK, even if we have a free trade deal with the EU from January next year, would not benefit that shipment of clothing, which would then be liable to duty, I think, at 12% commonly. So you need to think about supply chains much more broadly as well from next year. The answer to that would be, if it were possible, for rather than the goods go to the German distribution hub, for them to come directly from Mauritius to the UK. That may not be possible, but that's the kind of thing to think about. And so lots of pricing decisions and lots of things that affect, not in a good way, the way in which we're used to doing business. And it's a difference between a customs union and a bilateral free trade deal.
Right, wonderful. Thank you so much for that. I think giving quite a lot of insight there. So just to kind of get to the end and start finishing off, do you have any sort of like resources or advice on where business owners can go and sort of find out what they need to do, apart from obviously speaking to their accountant?
2 places. We have an increasing amount of material, I would say this, I suppose, but I've written it, so it is there on our own website, flyers and all manner of things that may help you. If you are minded to, the gov.uk website is useful to a degree in that it contains flow charts and guidance to try to steer you through what you need to think about if you're an importer or exporter. a number of my clients have said that it perhaps isn't as straightforward as it might be. Your local Chamber of Commerce, they have been really useful. I'm hearing some good things about how they're helping businesses. They are certainly worth consulting. They would probably be the three I would recommend. So us or your normal accountant, if you finding that they are well versed in this area, then brilliant. Or the Chamber or government and HMRC guidance obviously is there too.
Yeah. Okay, wonderful. Thank you so much for that. And I will try and find those links as well, and I'll pop them in the comments after the live is finished. So should we just move on to questions now? I think we've got quite a few in the comments, so I'll just start at the top. So this is from Alan, and he says, will I get a tax bill that will need to be paid before goods are delivered? Don't know any particular specifies whether it's in the UK, but I assume from the EU to the UK.
Yeah, if we deal with it that way around, the answer is very similar in either direction. One piece of good news, one of the things I hadn't had chance to cover, but can deal with now in the comments. At the moment, if you bring goods into the UK from outside the EU, you'll be paying both duty and VAT. From next year, as long as the freight forwarder you use completes your import entry in the right way, and there's guidance that HMRC do make available on how this is done, but there are certain fields to complete, then you'll no longer pay import VAT, but you would still pay duty if it's applicable. And to answer the direct question of do I need to pay that before I get the goods? Yes. However, having said yes, there is a process called a duty deferment account, which is basically at its simplest level, it's a direct debit with HMRC. So rather than you pay duty and VAT every time goods arrive in the UK, you give your freight forwarder, if he's going to complete your import entry, your duty deferment number. And when the HMRC computer sees that you have one, the goods are then released without paying the duty and VAT, because the taxes will be collected from your bank account on, I think it's the 15th of the following month. And one other piece of good news for those of you on the call today who may already have a deferment number, HMRC, if you apply, you need to apply and ask them, will in almost all cases waive the need for a guarantee. At the moment, you need a bank guarantee. Next year, in almost all cases, that wouldn't be the case. HMRC reserve the right to do some financial due diligence just to confirm that you're a good risk, I suppose, because they're releasing goods to you before you're paying the duty and VAT. So they reserve the right, rather than hold a guarantee, to make sure, in simple terms, you're good for the money, I suppose. So that's how that would work.
Yeah, that's quite interesting and good to know, that one. We do have a question here from Kate. She says, we use Royal Mail to send all of our items and fill in the customs details on click and drop. That means that our customers will pay import duty. I assume we have no way around that.
Your way around that, and I don't know enough about Royal Mail to understand how they would interact with this, would be if you are concerned about the experience from your buyer's perspective of having to pay those duties and VAT, is to find a way of consolidating the shipments into the EU and then treating that as one consignment. You would then have to pay duty and VAT yourself. And so one word of warning just in the short term, before the import one-stop shop is introduced in the EU, is if the individual sales that you make that are fulfilled via Royal Mail at the moment are below the €22 limit I mentioned, then you're going to increase the cost of those goods to yourself if you then consolidate them into one larger shipment, move them, and then break bulk them, I think is the phrase. I've seen that DHL advertise that at least. Break bulk them at the import end and then send them on their way individually, because that has been a single consignment from the UK to France, let's say, that will then incur duty and VAT, would then lead to you needing to register for VAT in France, and then sending the goods on their way. It's a big decision to make between, and it very much depends on the profile, I think, of where your customers are based. For some of my clients, they've got less than 5% sales into the EU, and they are deciding, do you know what, we're not going to sell into the EU for now. For other clients, and one of the fast fashion retail clients I can think of is going all the way down the other end of things, setting up a warehouse in the Netherlands. We'll hold stock there, and we'll build stock up there so that they can absolutely not disturb the customer experience, because they understand the import one-stop shop is coming in the future and will actually help in the long term. And what they don't want to do is lose their European customers in the short term while we make the transition from being in the EU and the customs union to get into the import one-stop shop in what might be a year's time. They really are concerned to bridge that gap.
Mm-hmm.
Also, actually, for that, sorry, Rachel, there's always something else.
It's okay.
For that client, they buy a lot of their clothing from Turkey. Turkey has a trade deal with the EU. It doesn't have a trade deal with the UK. So for goods being sold to EU-based customers, you would not want to bring those goods into the UK. You want to keep them in the EU because they're free of duty, which is 12%. Quite a lot, obviously, on your profit margin. So, big download.
Mm-hmm. Kate has also commented, so do we need to store stock overseas to use a different country's VAT code?
Yes, that sounds like an accounting question. And I'm probably getting out of my depth in how to deal with, depending on which accounting platform it might be that you're using. Sage, for example, has various different accounting codes depending on the country that you're selling into or from within, if that's where you've got your overseas warehouse. So yes, you would need to understand what the local French VAT rate was on the sale of those goods, if that's the country you're basing yourselves in, or the local Dutch VAT rate for that matter. So yes, you.
Right. Okay, wonderful. We have one more question here from Sheila, who says, I sell personalised products made in Germany that go directly to my customers, with some samples coming to me by courier. All orders will be under duty limit, but do I still have to prepare a nil duty declaration? I understand that these are due monthly and you have to have a special software link to the HMRC system, i.e. you can't do it yourself, so really don't want this for nil declarations.
That is actually, that does highlight one other opportunity which I touched on with my clothing retailer setting up something in the Netherlands. If your products are manufactured within the EU and are delivered to customers also within the EU, from a duty and VAT perspective, at least, that's the best possible answer. The answer to those customs declarations to HMRC is absolutely not, you don't, because the goods have not left the EU customs union of the now 27 member states. And so they are goods that originate in the EU and our destination is within the EU. So you would have, and Sheila, I couldn't comment obviously on whether you already have a German VAT registration that deals with the supplies of those goods from Germany to customers either in Germany or elsewhere in the EU, but that would be the outcome of that. You would have that obligation, but you would have completely avoided duty because you didn't cross a customs border.
Mm-hmm. Yeah, wonderful. I think there's just 2 or 3 more questions and then we'll probably finish up. If there are any questions after the live has finished, I'll try and send them over to Jonathan, and perhaps if he has the time, he can answer them separately. So Kate also comments, would she need to show 2 prices on her website, the UK VAT price and the France VAT price?
This, if you, there are a number of ways of answering it. If you advertise all of your prices VAT inclusive, which most retailers do, so you don't break out a VAT exclusive UK VAT on top to get to the VAT inclusive, which a trade business would, for example. A Costco do routinely priced that way, for example. So if you price VAT inclusive, then no, at one level, because I understand the price I'm buying from you at. It's then your decision as the retailer to determine what your VAT obligations are by reference to where the goods are sold and what prevailing regime you're caught by, whether it be France or the UK. But the issue, I think, as I touched on earlier, I suppose, is more difficult than that, because you may want two different prices depending on the cost of you getting the goods to your French customer in January next year compared to today, and the potential for you having an obligation under French VAT that may be a different VAT rate entirely to the UK VAT rate, because it isn't just a matter of standard rate to standard rate. Depending on the type of product you're selling, it could have a completely different reduced rate in France to the one it has in the UK. So it's the need to understand the effect that this has on your profit margin that might cause you to want to have differential pricing between two different markets.
Okay. Final question here from Bill, who says, B2C into Europe, what happens with VAT on goods over the higher threshold of £200?
Yeah. If they're over the higher threshold, then and you're selling those into the EU B2C from January next year, zero rated export from the UK, there'll be import duty, well, there'll be import VAT depending on the goods. Some aren't vatable, but at that level I'm sort of guessing it would be. And maybe duty depending on the free trade deal and the terms of that free trade deal. Once the import one-stop shop comes in, it won't cater for this level of goods. It's intended for goods up to the €150 it is threshold. Above that, you're going to need to just deal with the simple question, in theory at least, not a simple answer, of am I content to allow my customer to be the importer, or do I think I need to establish myself at least a VAT registration that allows me to import goods into the EU and then sell them from there? So the price might not change to the customer, but at least you relieve the burden on the customer of dealing with import declarations and payment of import taxes. So that I think answers the question.
Wonderful. Thank you so much for joining us today. I think we've got some really useful advice and we're very, very grateful for it. If you do have any more questions for Jonathan, or you want any more support with your EKM shop, please let us know in the comments or contact your account manager or our customer support team. That's it for today. We hope you all have a great Christmas break, and we'll see you next year for our next Facebook Live in January.
Thank you very much.